If you're serious about investing in real estate, you've come to the right place. It's a tough and yet very rewarding business, but to succeed, you really have to know your stuff. My name is Tom Lundstedt, and I first learned about real estate investing way back when I was a rookie Major League Baseball player. We didn't make the millions of dollars today's players do, not even close. Plus, I wasn't that great of a player, so I spent most of my time sitting in the bullpen where the pitchers and catchers who aren't playing go. And luckily, there was an old pitcher on our team. I think he was about 35, who had done pretty well investing in real estate. While the games were going on, he and I would talk about investing, and that really fired me up. As a matter of fact, it fired me up so much that I've been involved in buying, owning, managing, and speaking about rental property ever since. I've spoken to more than 2,500 real estate audiences from sea to shining sea, and I'm always amazed at how, even though things like interest rates, rents, expenses, and local markets are always changing, the fundamentals of real estate investing remain constant. To help people master these fundamentals, I've developed a series of CDs and study guides. They aren't a bunch of get-rich-quick baloney, they're the real deal. The fundamentals are time-tested and true, and they're a must for anyone who plans to succeed as a real estate investor. At the website, howtoinvestinrealestate.org, you'll see a sample of some of the information found in my CD programs. By using a terrific one-page, easy-to-use investment property worksheet, I'll show you how to analyze a property before you buy to determine if it makes financial sense. Topics such as cash flow, tax shelter, depreciation, cap rates, and return on equity will all be covered. We'll even cover how to use your IRA to buy and sell real estate. I can't believe how few people know they can do that. Now, before we go any further, I've got to put in a disclaimer. We're going to discuss some important tax issues, and I want to make it clear right up front that I'm not engaged in rendering legal, accounting, or other professional services. Everyone's situation is unique. So, before you take any action, please take the ideas you learn here and discuss them with your tax manager to see how they fit your unique situation. I'm saying tax manager on purpose. I'm talking about someone who help you manage your tax situation, not just prepare your tax return. So, let's get going. Whether you're a rookie investor or a seasoned pro, once the dust settles, I hope this website, plus the CDs and study guides, will help turn you into an all-star real estate investor. Okay, let's get started. What you're seeing here is part of a seminar I presented to a group of realtors. We use the investment property worksheet to analyze the 4 financial benefits of owning a rental property. Those 4 benefits are cash flow, principal reduction, income tax savings, and appreciation. In this first chapter, I'll show you how to determine a rental property's cash flow. We'll be using the same example that we use in each of the other chapters. A woman named Janet who is considering the purchase of a $130,000 small apartment building. The terms require $18,000 cash invested and a loan of $112,000 at an interest rate of 9.5%. The payments are $945 per month. Now, don't get all hung up about all the minute details or whether these numbers would be realistic in your specific area. Just follow along and concentrate on how it all works. Once you know how it works, you can apply these same techniques to any rental property in any market, big or small. Here we go.
When we're buying investment real estate, we're not buying bricks and mortar and green carpet and pink bathroom tile. We're buying a money machine. And the value of that money machine is determined by what? How much money it produces. If you were going to go down to Walmart and buy a money machine, what's the first question you'd ask the sales clerk at Walmart? How much money does this money machine produce, and how fast does it produce it? Well, that's the same thing Janet says. Let's say I'm the seller. Janet says, hey, Tom, I want to know your income. Well, the income on this property is $21,660. Put that on the annual rent right there. $21,660. That's for the year. Now, what does that mean, $21,660? So, well, see, what we're going to see here as we go along is there are 4 different types of income. So you really can't say to somebody, hey, what's your income? Because could she say to me, hey, Tom, what's your income? And could I think she meant, what's my income? When she really meant, what's my income? You see, so we got to be a little more specific. You can't just say, what's your income? This annual rent, this $21,660, is the total amount of income that Janet would collect if every unit in the building was rented every day of the year at full price. It's the total possible income. It includes garage rents, washer-dryer income, apartment rents, pop machine. Do you say pop machine? You say pop machine? What do you say? Soda machine. I was speaking in Florida, and I said to the lady at the front desk of the hotel, "Where's the pop machine?" And she didn't know what I was talking. She just looked at me. I said, "The pop machine. I want a Pepsi." "Oh, you mean a soda machine?" "Yes." Well, this would include the pop machine or the soda machine. Any machine. You know what they call it in New Mexico? Coke. They call it Coke, no matter what it is. Coke. Yep. If you have lunch in New Mexico, you order lunch, and the waitress said, "Would you like a Coke with that?" "Yeah." "What kind?" 7-Up. "Okay." Well, so anyway, this would include all the income you got, $21,660. Now, what are the odds that property is going to be rented every day of the year at full price? Not impossible, but it's unlikely. I know this is unbelievable, folks, but sometimes there's no tenants. And we need to take that into account. This is even more unbelievable. Sometimes even if there's tenants. You're way ahead of me. There's no rent, right? Just because you got tenants doesn't mean you got rent. And so we need to make an adjustment for vacancy and credit losses. See the little line that says less the vacancy? Well, that's your vacancy and credit losses. What are vacancy rates today? Well, it depends on where you are. I mean, that's a lousy question I'm asking you. There's no such thing as a vacancy rate. It would depend on what town you're in, where within the town. Wouldn't it depend on what type of property it is? Could you have 4 corners? On one corner, apartment building, shopping center, office building, rental house. Could they all have completely different vacancies? Yes. Yes, yes, yes. So you would determine the vacancy in your market. Let's say the vacancy is 5%. Help me with a calculator. 5% of $21,660. We're going to take that out of there. If she gets any of that money, that would be a bonus. Let's not count on it for Janet. Is that 1,083? All right, 1,083. Let's take that 1,083 out of there. And she's left then with, what is that, 20,577? Check my math now. 20,577, and we call that 20,577 her gross operating income. GOI, gross operating income. What is the definition of gross operating income? Put in words a baseball player can understand. I don't know what that means. It sounds like earned run average. I couldn't figure that out either. What is gross operating income? Yes, that's it. This is what she actually collects. 20,577. That's what she takes in. She doesn't take in 21. She takes in 20,577. So if she buys this property, should she immediately go book a $20,577 cruise around the world based on her profit from this little business? Might that be a little premature? Because now what does she have to do? She's got to run the business. She's got to operate the business. She's got to pay her operating expenses. Look at the next lines. There are your operating expenses, things like utilities, insurance, repairs and maintenance, management, real estate tax. All those things are operating expenses. Doesn't it make sense we need to know the operating expense? Yes, that's fairly obvious to everybody in here. And yet, as obvious as that is, how many of you have ever dealt with or talked with people who value buildings based on how many times the gross income the price is? How many of you heard people say, I pay 6 times gross or 7? What they're saying is, this cost, 130, is 6 times your gross operating income. And that's how some people value buildings. What do you think of that method of valuing a building? Good method, bad method? Not very good, is it? Is it simple? It's simple, therefore popular, but could you lose your shirt buying real estate could you lose your entire wardrobe buying real estate that way? Sure. What's the problem with that? What if I said, Janet, come on, I'll sell you the building for 6 times gross?
Doesn't have a roof.
Well, I forgot to tell you the expenses are 7 times gross, right? It doesn't say anything about the expenses or the what? The financing. Expenses or financing. And what about those 2 minor variables?